Welcome back, everyone. This is the oil market review for the 11th of November. The volatile season for the oil market continues as WTI stabilized at higher grounds in the past days. In the most recent daily sessions, WTI's price had undertaken considerable swings that will be detailed in this report, along with the most important fundamental updates in the industry. Our WTI technical analysis will be presented as our final part of this report, providing insights on important levels for traders to consider. Enjoy the report. In the past days, the US weekly oil market data created some volatility for WTI's price, thus could be worth keeping in mind for the days to come. On Wednesday, the EIA weekly crude oil inventories figure displayed a surplus of 1 million barrels, which was lower than the forecasted and previous figure. The reading sent WTI prices in a bearish momentum, reaching nearby $80 per barrel, while the selling was ongoing for a few hours after the release. On the flip side, the weekly API crude oil inventories released on Tuesday indicated a notable drawdown of minus 2.5 million barrels, which sent prices higher, reaching approximately $83 per barrel. During the previous Friday, the weekly Baker Hughes oil rig count implied active US oil rigs jumped to 450, which was higher than both the previous and the expected figures. No major reaction was observed upon release. Yet from the reading, we understand that active oil rigs continue to be on the rise but remain far from levels seen prior to the pandemic. Our conclusion remains intact that traders are monitoring the weekly readings, with most emphasis placed on the EIA and the API, and this behavior can follow us well into the next week. In the past days, the EIA released its November 2021 monthly report that included some interesting information in accordance to the administration's views and outlooks. Some of the topics we found interesting and could move oil prices include: first, the fact that a number of countries like Thailand, Israel, Australia, and the United States have now opened their borders and traveling for tourism or business is now allowed. This move could uplift fuel demand. Second, the EIA approximates world crude oil consumption has exceeded crude oil production for 5 consecutive quarters, which is a confirmation that oil supply has remained depleted, possibly due to the uncertainty surrounding the pandemic. Moreover, the EIA clearly stated oil demand will exceed global supply through the end of the year and keep the Brent crude oil price above $80 per barrel through December. Finally, a more long-term view by the EIA found the administration expecting global oil stocks to start building in the next year, driven by rising production from OPEC Plus and the United States, accompanied by a deceleration growth in global oil demand. In this scenario, the EIA expects downward pressure on oil prices. As a final note, we would like to advise caution for traders considering the news related to the US government using its strategic oil reserves to bring prices lower. This idea had been considered in the pre-pandemic era many times, but did not materialize, as this may not be the most appropriate move for the time being. Lastly, according to Reuters, the most recent months have been the weakest for fuel exports from China, which were impacted by plummeting fuel demand across Asia, with lockdowns imposed in countries in the area. China has also been affected by high energy prices, which led to a cut down on its imports of the commodity, while the internal energy crunch the country is facing may also be among the reasons for lower imports and subsequently lower exports. Moving now to our technical analysis, please note this is WTI's 4-hour chart. At the moment, WTI has stabilized in the range between the R1 80.85 resistance and the S1 79.05 support. The R1 level was tested on Thursday's early European morning, but the price action moved lower thereafter, while the S1 was attempted in the most recent sessions, making them both very obvious to traders at the moment. If the bulls take over, the R2 82.25 resistance could be attended, while considering higher grounds, the R3 83.70 is the highest price reached so far in November. If the sellers are to take over, then below the S1, we note the S2 77.65 support that was tested only once in November, thus remains the lowest price in the month. Yet our lowest level for this report remains the S3 76.25, which was used previously as a resistance and a support. Overall, even though the commodity is currently in a selling trend, we view a larger sideways motion between the S1 79.05 support and the R3 83.70 as the most active area for WTI's price action. Evidence of some bearish tendencies in the short term is also the RSI indicator below our chart, which is running across the 40 level. Thank you very much for your time and focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.